Good morning and welcome to today's webcast, SAS 136, Applying Lessons Learned for the Future. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and with that, I'll turn it over to our moderator for today, Katrina Blackwell.
Thank you. Good morning, everyone. Welcome to our webcast this morning, SAS 136, the lessons learned from implementing SAS 136 last year. I'm so excited to introduce our speakers today. My name is Katrina Blackwell. I'm a partner at Moss Adams in the Los Angeles office. I specialize in employee benefit plan audits, and I will be your moderator today. Our speakers today will be Erin Goldfarb. Erin is a partner at Moss Adams in our Fresno office. She's a leader in our employee benefit plan practice in Northern California. She specializes in benefit plan audits and with an emphasis in ESOPs. So we're very happy to have Erin as our speaker today. Also joining her is Jered Villacorte. Jered is a senior manager here at Moss Adams in our Los Angeles office. He also specializes in auditing employee benefit plan audits or employee benefit plans. And he also helps to train our people in everything benefit plan related. And I'm so excited. This is a great presentation today, packed full of lots of information. So thank you so much for joining us. And I will turn it over to Erin.
All right. Thank you, Katrina, and good morning, everyone. Thank you for joining us this morning as we go through SAS number 136, Applying Lessons Learned for the Future. And I have my co-presenter, Jered, here with me today. Jered, how are you doing? There may be a little bit of a delay. I know he's there, but Jered and I are really happy you joined us.
Sorry, it's a typical, online. I'm on mute.
That's all right.
Excited to be here.
Yep, exactly. Thank you, Jered. I appreciate it. Sorry to put you on the spot like that. I just wanted to communicate that Jered and I are really happy that you're here today as we recap our observations of the past year and include our best practices to make your next year's benefit plan audit a success. So our overall goal is to make sure that you have some key takeaways and some best-in-class suggestions regardless of whether or not you're a plan sponsor, an auditor, or a service provider. So please feel free to get comfortable, grab your coffee, tea, water, whatever you're drinking this morning, and spend the next hour with us to talk about SAS 136 and lessons learned. We're also going to be talking about reportable findings, relevant plan provisions, and then we'll close it out with auditor's reports. And then no CPE would be complete without learning objectives. So at the end of this session, we hope that you are able to describe the impact of SAS 136 on employee benefit plan sponsors, discuss lessons learned as we approach year end and prepare for next year's audits, and then provide recommendations for educating plan management on recent changes that can help overall plan administration and operations. And I think, Emily, we have a polling question to start off with.
All right, thank you. Our first polling question today: which position best describes your role? And your options are A, I'm a benefit plan auditor; B, I'm a plan sponsor; C, I am a service provider; or D, other. So I'll give everyone a moment to think about this. To participate in our polls today, please click the button next to the answer you choose and hit submit. So just a few more seconds here on this first poll. All right, let's go ahead and see who we have on the call. Erin, back to you.
All right.
All right.
Let's see. So we have some auditors on the call. We have plan sponsors, service providers, and the majority is other. If you feel comfortable, please feel free to put what your role is in the Q&A or the chat, just so we can make sure that we are tailoring our content towards you. And then also, I should clarify too, plan sponsor means that you work with or work for a company that has an employee benefit plan. So that could be like a CFO, it could be a member of HR. And so really our content is geared to all of these parties, but we really want to make sure everyone takes away something valuable from this. So
yeah, and I could definitely say, looking at these results, at least for the non-other category, the I am a plan sponsor, I think it's helpful in looking at our content. I think it's helpful to see that. I think that's where a lot of our content is structured to. So this should be a good session for everyone.
Absolutely. All right. So before we kind of launch into lessons learned, I wanted to recap and see kind of what we expected from SAS 136. So SAS 136 is actually titled Forming an Opinion and Reporting on Financial Statements of Employee Benefit Plans Subject to ERISA. And one of the significant effects of 136 was that it clarified the responsibilities of plan management. These responsibilities always existed, but what it did was crystallize and clarify these responsibilities. What it also did was require the auditor to obtain evidence that management acknowledges and understands its responsibilities. So it's kind of like a two-part requirement there. So most employee benefit plans are in a calendar year, which means that 136 was effective for your audit of December 31st, 2021. And there was an option to early adopt, but most CPA firms did not. And then just, as a reminder, SAS 136 only applied to employee benefit plans under ERISA. So what it did is, it really shifted the nature of benefit plan audits from being more compliance-based to requiring the auditor to focus on what is referred to as relevant plan provisions. So for those not familiar with the terminology, a plan provision is basically a description of what the plan provides and how it operates. So if you allow entry into your plan upon the age of 18 and completing, let's just say, 3 months of service. That would be the plan's eligibility provision. So really what this did was require the auditor to really look at the plan's provisions and A, determine what provisions are relevant, and then B, design and perform procedures to test these provisions. Another thing that 136 did, which I think helps paint the picture of just changes in the industry, was that it replaced the term limited scope audit with ERISA Section 103A3C audit. Now, I know the latter, ERISA Section 103A3C audit, does not roll off the tongue as easily as limited scope did, but it was actually an improvement, and it provided a significant change to not only the name, but the type of audit opinion we issue as CPAs. And so let me explain what I mean by that, and hopefully this makes sense, but especially to my auditors in this session. But ERISA Section 103A3C has always allowed plan administration to instruct the auditor not to perform any procedures or not to perform any auditing procedures with respect to certified investment information. And this provision has been present since ERISA was written in 1974. So nothing changed there. So SAS 136 didn't create ERISA Section 103A3C. It always existed, and that was actually the section in which limited scope audits were performed. Now, for those who are familiar with auditing standards, when management imposes a scope limitation on an audit, whether it be an employee benefit plan or a corporate audit, the appropriate opinion issued is called a disclaimer of opinion. And so when we were performing limited scope audits prior to SAS 136, we actually issued a disclaimer opinion on the auditor's report, which the wording quite literally states that the auditor does not express an opinion on the financial statements. So we would perform entire audits, do a lot of testing, and basically touch everything or consider testing, everything except for the fair market value of certified investments, only to not express an opinion. So this was actually kind of strange, but considered to be industry standard. So what SAS 136 really changed was how this reliance on a certification was looked at. And SAS 136 provided that because Section 103A3C is unique to an employee benefit plan, SAS 136 introduced the idea that an audit performed on an employee benefit plan with a certification is no longer considered to have a scope limitation. And without a scope limitation, we wouldn't have a need to issue a disclaimer opinion. So both the DOL and the AICPA were supportive of this change, as it was thought to that removing the disclaimer opinion would increase audit quality. So now under 136, we express something called an unmodified opinion, which still exempts the certified investment information, but allows us to express that the information in the financial statements related to asset certified is in agreement with the institution that prepared the certification, and also allows us to actually express an opinion that the amounts and disclosures in the financial statements are presented fairly. So overall, a pretty significant change. One of the things that I mentioned SAS 136 clarified was management's responsibility. So these are a few points that each have supporting slides related to them. But I just wanted to reiterate also that that management's responsibilities didn't change from the implementation of SAS 136. What did change was that the auditor now had to obtain evidence that management acknowledges and understands its responsibilities. So we will be going over each of these points in greater depth. And Jered and I, as we go through, will offer some best practices. So if you are representing a plan sponsor today, you can come away from this presentation with some ideas of what you may be doing well and possibly what you can improve upon. And then, of course, as we get into these points, I don't think I mentioned this before, please feel free to put a question if you have one in the Q&A box.
And Erin, I guess just to mention too, in this last list of management responsibilities, as Erin mentioned, a lot of these are consistent with what has been done in the past or what you have been doing prior to SAS 136. And so we can talk in detail about each of these individually, and we will. But I think one of the key ones to also just mention here too is, while there are new management responsibilities or clarified management responsibilities, I think as Erin mentioned earlier, there are also auditor responsibilities. So it's not all in your hands with these changes. We do have some of our own responsibilities with these SAS 136 changes as well.
Excellent point. Thank you. Thank you, Jered. So beginning with the first one on our list, management's responsibility to maintain a current plan instrument, including all plan amendments. So one important thing to note is even though your record keeper or auditor has this information, it is management's responsibility to maintain these documents. And the main instrument that this is referring to is the basic plan document and the adoption agreement, along with any amendments. So you should also be maintaining a copy of your IRS determination letter, a current summary plan description, which is basically the summary version of the plan document that's provided to plan participants, and then any other documentation related to administering the plan. So this could be in the form of agreements with your record keeper, agreements with your auditor, and any sort of trust agreements. And during your annual audit, your auditor will be requesting these documents, and ideally they should be able to be provided in a quick and organized manner. And I said that we'd note some best practices. So as far as what we would recommend and what we've seen plan sponsors do well here is I've actually had a lot of success and have been able to perform a more efficient audit when clients are able to produce a complete set of plan documents during the planning stage of our audit. Another important thing is making sure that you are maintaining final copies, fully executed copies. I understand sometimes, especially in the beginning, there could be, some retention of drafts, but really you want to make sure that you are keeping the fully executed copy. Usually these audits are performed in the spring and the summer. The other thing that is important to note is there may be documents that were in effect during the year-end audit, but have been revised subsequent to year-end. And, of course, always ask your auditor what they need, but usually they're going to need both. One for actually, their audit of the year, and then the other for evaluating subsequent events. Areas where we could see some room for improvement is actually completeness. I think what's difficult sometimes is, we'll provide a list and, the client may provide a plan document, but maybe it's been revised, midway through the year. And so just making sure all of these files are in one place can really, really go a long way in making your audit more efficient. And then also, if you need to refer to them, you know where they are. Let's see, Jered, did you have anything to add here with regard to files?
Definitely. I think what's helpful are talking about, pitfalls or best practices. I think focusing on this last one is also one point that I've seen with some clients as well, where you're keeping active and also removing any superseded or older documents that aren't active. There are times where we're making changes to the plan and we have to run specific amendments for changes just to change references within specific adoption agreements or plan documents. But there are times where an over-encompassing big change will happen after the fact. And I think where the confusion may lie is if you aren't superseding or deleting old amendments or old plan provisions that aren't necessary to the plan, you may have some internal confusion on how the plan actually functions if you open up the wrong document. And so you might then be functioning the plan inconsistent with how the plan is supposed to be run based on the legal documents. So the point being there is make sure you have an understanding of the current plan provisions and the current documents, and any of the older documents, you're careful to supersede them or keep them for the retention 7 years that you need to, and then move them forward.
Absolutely. So if you could put on your calendar, an hour's worth of time to go ahead and track down and label your plan documents, I think that's going to save you, some time in the future, most definitely. And thank you, Jered, for those additional points as well. So the next point here, I think what Jered said really helps to segue into is the management's responsibility for the administration of the plan. So this includes, that determining the plan's transactions are presented and disclosed in the financial statements in conformity with plan provisions. So revisiting what a plan provision is, a plan provision is a description of what the plan provides and how it operates. And failure to operate the plan in accordance with plan provisions is considered an operational failure. So I used the plan's eligibility provision as an example earlier. And eligibility is an easy one to highlight. And using my example earlier with an age and service requirement, do you have a control in place to ensure that you're monitoring completion of that age and service requirement? And once that has occurred, are you offering everyone who has met that service requirement into the plan? And as I think a lot of you know, failure to offer participation to eligible participants is considered an operational error, as is incorrectly excluding employees from participation. And so having on the previous slide, having your plan documents in one place and making sure that you are operating your plans consistent with those plan provisions. Another common error we will see is the plan sponsor using an incorrect definition of compensation to calculate contributions. We actually really saw an increase in this when COVID pay codes started being added to payroll systems. What you really want to do is review this periodically to make sure that you understand the plan's definition of compensation and that all of your pay codes in the system are either marked as included in the plan, in employee benefit plan withholding, or excluded. And this comes into play when a participant, elects that they would like to withhold, let's just say 5% of eligible compensation for their employee benefit plan. So we did see a little bit of an uptick in errors because I think COVID pay codes were, added to the system rather quickly. But it's a best practice to put some time on your calendar and do a review of those pay codes to make sure that you're running the plan and the functions and responsibilities that you have. They're consistent with your plan document.
All right, perfect. So
go ahead.
So now talking about another management responsibility that SAS 136 clarifies. One is around the participant records of the plan and who should be maintaining them. So the first, there's a couple helpful questions here on the slide that helps people get thinking here, but really the first question to start off with is which records are sufficient? And really who's keeping these records is maybe what management or plan sponsors should be thinking about. But technically, management is responsible for like all of the records of the plan. And that would generally include things like deferral percentages and investment elections and things of the sort. Now, when I say all of the records, that may feel daunting, and I don't think that you're in this alone. And generally, from the plans that we see, you actually share some of these responsibilities at times with people like your record keepers, right? These third-party administrators that help you actually run these plans and help your participants to keep the plans in compliance, but then also with the intentions of the participants. But the question may come up as management, as if I'm using Fidelity as my record keeper, what are they doing for me versus, let's say, like an Empower? And so how is management really supposed to know what are we supposed to do and what does that third-party administrator do for us? And that's where I think the second bullet point is really helpful, to talk about the SOC 1 of the record keeper. Just to reintroduce the idea of a SOC 1 and what that does for our audits, and then also for plan sponsors, is the SOC 1 is its own type of audit report, but specifically about the controls and processes at your third-party administrator. I would say it's kind of a little bit of a stamp of approval to kind of tell you as management, what are the things that a Fidelity or these other record keepers are doing for me, and how much can I rely on them? And that's very helpful to understand, again, what records are they maintaining for you? What processes are they handling? The secondary part of it, and really, what we see is sometimes a common pitfall with certain clients, is really the flip side of it. These SOC 1 reports also include the CUECs, which are referred to really as the complementary user entity controls. These are really the controls that management should have internally on the company side to ensure that you are using the system correctly and that you are covering everything that should be done internally so that the system can run appropriately and provide the right reporting. As any auditor would like to say, and probably been saying this for a while now, but garbage in, garbage out systems, right? It's, if you put good information into the system, it should produce good reporting and functionality out of it. And I think with that, it's I think really honing back into this first question of what records are sufficient, and really where should, from our perspective, plan sponsors be honing in on their attention and controls. It's really about keeping accurate and timely participant records. That would be participant names and information, their dates of hire, termination. All of these kind of indicators and dates are what drives record keepers to be able to do their jobs appropriately. And anytime this information may be inaccurate, that provides an opportunity to put incorrect information into the system, to provide incorrect out of the system. So, we mentioned to clients that, some clients might also mention that we have looked at this last year, 2 years ago, and we were covered then. It's also a best practice, I would say, that to be reviewing these SOC 1s on an annual basis, because one, the controls and procedures at the company may change, but then also the CUECs, the specific controls that the plan sponsors should have, may also change as well. It depends on what that audit and what that SOC 1 comes up with every year. So I would say that this is a best practice that we would say there's a lot of area of improvement. Outside of other participant records, these last two bullet points are really, I think I kind of alluded to this, but are there any exceptions or issues with the participant records? Again, bad information in would be bad information out. And then lastly, are there any complaints related to the record keeper from your participants? I think that's an important one as plan sponsors to think about and make sure you're touching base with your employees. If they're seeing something wrong at the record keeper side, even if the SOC 1 says it's supposed to be doing something, it's a responsibility of management to look into these issues and see if there's a systemic issue that they should be researching with their third-party administrator. So I think I went through a lot of participant records and information there, but any other ideas there, Erin?
I just wanted to reiterate one thing that you had mentioned, and that was looking at the SOC 1 for your payroll provider or your record keeper, and reviewing those complementary entity user controls. And you can actually open up your SOC 1, put that in the search bar, complementary user entity controls, and it should take you to the right spot. And one of the areas, especially in this day and age of technology, is those user controls are basically where your service provider is saying, all right, this is kind of where our responsibility ends, and this is where your responsibility begins. So a lot of times, a plan will allow a participant to change their elections online. So it's easy if you're a plan sponsor to say, hey, this is a process outside of, my involvement. But you'd be surprised sometimes, there are some explicit requirements that a plan participant may have that, perhaps because you're not directly involved in the process, you may think that you don't have a responsibility for it. And then the other item that sometimes we see is, document retention policies. I'm sure all of your companies have document retention policies in place. However, SAS 136 requires that management must maintain records for anyone entitled to a benefit in a plan until that former employee is no longer entitled to a benefit. So this means that you could have participants that have terminated but still have a balance in the plan. So for those participants who have terminated, you should be keeping evidence of their termination date. And, for example, if it's your policy to destroy files for terminated participants after a certain amount of years, you really need to be looking at their participation in an employee benefit plan and adjusting that retention policy accordingly. And then I think we have a polling question.
All right. Our second polling question today. How did SAS 136 implementation go for you? And your options are A, great. I love SAS 136. B, luckily I did not have to deal with SAS 136. C, I wasn't fully prepared for it. D, I didn't really notice anything different. So we'll give everyone a couple seconds to think on that. And as a reminder, if you would like to receive CPE credit for today's presentation, you'll need to respond to 3 out of the 4 polling questions. And this is our second question today. All right, let's go ahead and see what everyone had to say. Back to you.
All right, perfect. So we have a kind of a mixed bag here. I'm happy to see that responses for C are on the lower side. And then it's great that you didn't notice anything different. That's helpful. That likely means that you were doing everything that you were supposed to, which is great. So thank you everyone for responding to this. Just moving on with management's responsibility, the Form 5500 had some changes, or rather, the management of plan sponsors and auditors had changes, or I'll say more formalizations of what should be done with regard to the Form 5500. And for those of you who are unfamiliar, the Form 5500 is the plan's informational return that it files with the IRS. And it's due on July 31st. Extension is through October 15th for calendar year plans. And some of the things that management can do with evaluating the Form 5500, to help fulfill their responsibility with providing a substantially complete Form 5500 prior to the dating of the audit report is, obtaining that Form 5500 early in the audit process. It's important to make sure that you're communicating with your plan auditor and the preparer of the Form 5500, if those two parties aren't the same, to make sure that there's plenty of time to provide that Form 5500 to the auditor prior to the finalization of an audit. And really, best in class is providing that Form 5500 draft during the planning phase of the audit. Management should be cross-checking the plan's financial statements to the Form 5500, and if major line items don't agree, for example, changes in net assets, then a reconciling footnote should be included in the financial statements. Also, making sure you're reviewing all of the schedules in the Form 5500, not just the financial information, And also remember that if your auditor has any suggested changes, those should be reviewed and approved by management. And this is just because management is responsible for the accuracy of the information within the Form 5500. And the auditors have some responsibilities here too, which I will go over. With regard to auditors' responsibilities in the Form 5500, it was always a best practice prior to SAS 136 for the auditor to review a substantially complete copy of the Form 5500. But what SAS 136 really did was formalize this responsibility. And now it's required for the auditor to obtain and read the substantially complete Form 5500 prior to the dating of the auditor's report. So because of this, it's really important to give your draft Form 5500 to the auditor early in the audit process. One of the key takeaways after this first year, like I'd mentioned before, is just making sure you're communicating with the preparer of the Form 5500, so that way there's plenty of time for the auditor to review it, and that gives everyone enough time to resolve any material inconsistencies identified. And as I had mentioned before, SAS 136 changed the type of opinion we issue as CPAs and as auditors of the plan. And so this is just a little excerpt from the Form 5500 Schedule H, Part 3. And you can see in 3A, we have circled the area where it says the attached opinion of the independent qualified public accountant for this plan is, and that was previously most of the time under limited scope auditing, the box was checked under 3. But this year it was changed to unmodified due to the changes in the type of audits we perform under 136. The other area too that changed was 3B, and this just references if the auditor performed a Section 103A3C audit. So just as a reminder, in the past, the terminology was limited scope audit or full scope audit, and a full scope audit basically meant that there wasn't a certification, and that the auditor would have to consider testing the investments in the plan, or test the material investments in the plan. What our terminology is now is basically we perform a Section 103A3C or a non-Section 103A3C. So a little bit more complicated, but like I said, it was a change for the better in terms of clarifying, really what we do when we audit these plans. All right, and then regarding the Section 103A3C audits, one of the most important changes of 136 was management's responsibility to determine if an ERISA Section 103A3C audit is appropriate. So this slide just recaps what I had said earlier, and the change in the type of opinion from going from disclaimer to an unmodified opinion.
Perfect. And so really just to kind of clarify some of those, are really what is management's responsibility with this change, this being one of the bigger ones, is management should really, again, be actually doing the assessment and the formal determination that the plan is working with a qualified institution to allow one of these special ERISA Section 103 audits. And so the second bullet point really kind of gets to that a little bit more, talking about that ensuring that the management understands that this information is prepared and certified by a qualified institution. And it kind of lists some usual players that would be allowed to certify in this way. It could be a bank or similar institution, an insurance company, or assets held by a qualified institution. And along with actually having a qualified institution, that institution should also be able to provide an actual certification in accordance with bullet point number 3. You can see the regulations there. And so just ensuring that not only do you have a good institution, but if you look at the statements that they provide and the certifications, does it actually provide a certification under these regulations? And so moving along, these are some helpful questions, and I think, we won't go through one by one with them, but this is a helpful slide for you to take back home with you and really, after, double check and look at who are you working with for your institution for the plan, who's handling the trust, who's the custodian for the plan, and see if they actually pass any of these questions or tests here. Really, is it being certified by a qual institution? The person that's actually signing the certification itself, is that an authorized signer of the company, of the third party that you're using? Does that certification actually cover all of the assets? Does it mention the plan name? So these are all helpful things. And I think just as helpful guidance for anyone that's more interested in what a qualified institution is the AICPA actually has a questionnaire that you can find online that really gives a lot more context as to, how can you evidence this review process? How do you know that you're working with the qualified institution? And really might even be a good tool for you to document. But that's kind of on a one-off basis. But again, there is a tool from the AICPA that can be really helpful. And then moving on to this next slide here, I think Erin will cover some of the common deficiencies, which again, I think the AICPA also does a good job helping us and showing kind of a reflection of what we saw with our certifications this year. But Erin, go ahead.
Yes, absolutely. Speaking of tools, the AICPA Employee Benefit Plan Audit Quality Center has a really good audit engagement tool that highlights some of the common deficiencies in ERISA Section 103A3C audit certifications. So some of the areas where you might find challenges is making sure that you're obtaining a certification for each custodian if you've changed custodians during the year. Sometimes there are omissions and errors in the certification. For example, the plan name is missing, the certification isn't signed. One of the areas that I see here and there are when a certification doesn't include all the investments in the plan. For example, I have a client who has registered investment companies, or in other words, mutual funds, as an investment in the plan, along with a guaranteed investment contract. And their mutual funds are certified on one certification from Principal Trust Company, and then the guaranteed investment contract is certified by Principal Life Insurance Company. So I believe in the audit package, only the one from Principal Trust Company is provided. Usually they have to request the other one. So sometimes it's not as straightforward as we'd like it to be. And it's always a best practice to make sure all of your investments are listed or included in the certification. And information improperly certified. Certified statements can include assets that are held by a separate custodian, similar to what I had mentioned. And there are instances, I don't see this very often, but incorrect or improper information. For example, certification includes investments purchased after year end, and this may just be a sign of poor cutoff. And fortunately, I haven't actually seen this in practice, but it does happen. And then I think here it's important, like Jered had mentioned, is to also communicate that, hey, we're in this together. It's not just the plan sponsor that has responsibilities related to this. The auditor also has responsibilities. And the AICPA Employee Benefit Plan Audit Quality Center has a resource that isn't necessarily needed, but if you're ever curious as to what an auditor needs to be doing related to certifications, they have a resource called Documentation of the Auditor's Evaluation of Management's Assessment of ERISA Section 103A3C. So really, It's management's assessment, but then we are required as auditors to evaluate it. So for my fellow auditors out there, it's could be helpful to use as a guide if your firm doesn't have its own proprietary evaluation tool. And I think we have, Emily, a polling question.
All right, our third question, what is a qualified institution? And your options are A, banks, trust companies, and insurance companies, if regulated. B, record keeper, C, brokerage firms, or D, all of the above. And for those of you that would like a copy of today's slide deck, you can download them now from the slide deck and handouts folder. We'll also be sending the slides via email after the webcast. So we'll give everyone just another moment here. All right, let's go ahead and take a look at the results. Back to you.
All right, thank you, Emily. You know, this is probably a little bit tricky, but our answer is actually A, banks, trust companies, and insurance companies, if regulated. You know, that question was probably a little bit harder than it should have been, but usually a record keeper is not able to certify, and brokerage firms are not either. So it needs to be a regulated company, and usually most often we'll see banks, trust companies, and insurance companies. With regard to, you know, maybe you're saying, no, you know, Erin, my record keeper certifies the investments. Take a look at that certification. It's usually under their trust company. So that's also just a little distinction. And that wraps up our discussion about certifications and responsibilities related to Section 103A through C audits. And I think Jered's going to take us through some considerations related to reportable findings.
Thank you. Yeah, and I think that last poll might be helpful just to show that, you know, maybe we need to each individually do a little bit more research and just double check to make sure we have a good qualifying institution for our plans and that we can actually do these Section 103 audits. So a couple more additional changes with SAS 136, just to quickly kind of work through. There is now a new, I guess, wording around reportable findings and the fact that this is the auditor's responsibility to ensure that, you know, management has a fair chance to understand, you know, as a reflection of the audit, what did the auditor find? What issues were noted? What opportunities for improvement were there? And now that's, I don't think it's a new requirement, but it's probably a more clarified requirement where now the auditor should be doing this in writing to those charged with governance on a timely basis. And that should just, again, encompass any deficiencies in internal controls or processes that were noted during the audit, just to clearly communicate to management to allow them an opportunity to make changes to your processes. So I really don't think this is a big change, but maybe it's more about the clarification of how these should be communicated. From the flip side, you know, the management responsibility. Management should understand what issues were actually noted and do their best to make process improvements to ensure that the plan continues to run appropriately and, you know, reduces the risk of any errors or issues happening. Here's just a quick list of common reportable findings that we saw when we were doing our audits this year. And some of them actually is things that we've already covered prior in the presentation. So the first bullet point here is SOC 1 control objectives and CUECs, or those complementary user entity controls, those specific plan sponsor controls, that those are being reviewed annually. And obviously every auditor is going to ask you, well, can you show me that you actually did that review process? Actually having an evidence of that review process happening each year is also one of the common reportable findings that we do see in areas of improvement that we would see our clients working on this year for next year's audits. Other areas of improvement would be maintaining current agreements and amendments. I think we saw issues either with having the current agreements, not actually even maintaining them themselves internally, or having a log of them. Maybe, I mean, I think in the worst case scenarios, over-reliance on your auditors and their ability to actually house these internally. That is not a best practice, and that is something that, you know, should be improved. And then lastly, just for overall key management controls, things like payroll close processes, adding employees to the record keeper system or your payroll systems, ensuring that you have a good documentation of your workflow process, of your control process. What are those key areas to ensure that the plan is functioning correctly, and evidencing those review processes, again, obviously with some type of sign-off, checklist, things of the sort. So these are just the quick reportable findings. Moving on from there, I think just reintroducing the idea of relevant plan provisions and giving plan sponsors some comfort. And I know that there's some auditors sitting on the call today too, but really the focus here for our audits and what the AICPA guidance points to is really that we need to focus on relevant plan provisions. And that might be different depending on the plan. And so really, I think this is a good way to really connect the regulatory environment of how should the plan be running with the materiality world that auditors really see of, what is really the risk areas of this plan or the instruments that they use or the specific plans provisions that this plan has, and even the plan's sponsors, controls, and processes. Are there any gaps or areas of higher risk that would be a more relevant plan provision that we need to look at? So just giving more context as to what are we doing in the background as auditors, and how are we helping plan sponsors ensure that our plans are functioning correctly. I think with this slide here, we are jumping into our last polling question. So Emily, if you want to take it away.
All right, thank you. Our final polling question today. Did you note significant changes to final communication due to SAS 136 implementation? And your options are A, yes, we noted many more reportable findings communicated in the final letter. B, no, the communications were about the same as the prior year. C, we have not communicated or received our final results to those charged with governance. Or D, I'm not sure. So we'll give everyone a couple seconds to think on that. And once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window. Just another moment here on this final polling question. All right, let's go ahead and see what everyone has to say. Back to you.
All right, let's see. So there were some reportable findings. It looks like no, communications are about the same as prior year. Again, I think maybe just reflecting on that response a little bit is maybe your auditors were good about communicating these reportable findings. And again, this is more of just a clarification of how we're supposed to communicate them and where. Or we have not communicated, received our final results to those charged with governance. It might be an indication that you didn't have any significant findings. It might depend, but I think this is at least a hopeful results here to show that we are at least improving or adding some communication, but there might be still some areas of improvement. All right, and then moving on to our last slide here. So talking about this last slide, I think this is really just, another reflection of the fact that, with this SAS 136 change, our audit reports did have somewhat of a change. There's definitely an order change of the audit reports, which anyone doing a side-by-side comparison of their prior opinions to the current year opinions, you'll see that the order of things have changed. But I would say one of the key bullet points here that's probably helpful and is a new section for sure is the specific fourth and fifth bullet point here around the responsibilities of management for the financial statements and the auditor's responsibilities for the audit of the financial statements. I think, really, if you haven't taken a in-depth look at this specific section of the audit report, it's really helpful for management to understand, the division of responsibility here and who is doing what. A lot of those items we talked about today, so you have a good feel for what those items that we dealt with last year were. But mainly, this is kind of a key area that I think could be helpful for plan sponsors to take another look at if you haven't already. I think another thing to highlight on these audit reports is if you're looking at the report and more specifically the last couple paragraphs, it talks about other matters. There's usually a reference to the prior year audit because it had a limited scope audit and was done with generally a disclaimer of opinion under that limited scope provision. Well, now with 2022 audits in the future being done with 2 years now under SAS 136, we will probably see a drop off of that other matters paragraph, and you will see a reference of 2 years of audit reports being done under this section 103 audit. Not a huge change for everyone, but I think the big takeaway from this slide is if you're doing a comparison next year for your audits and they look exactly the same, it's generally not appropriate. There should be some type of change in that last couple paragraphs, specifically that would have referenced the 2020 audit that was done under a limited scope audit. I think that's all we had to really talk about in terms of audit reports. And so that really does round out our presentation today of the content that we did prepare. It looks like we're at 9:55, and I think this does go in until 10 o'clock. And so with that, I think we have a little section here for any Q&A and questions that we wanted to highlight. I believe our moderator,
thanks, Jered.
Katrina's
Thanks, Jered. I can jump in and we can get a few questions in here. Okay, so Jered, in an organization, what functional role typically reviews the SOC 1? Is it HR? Is it accounting? Is it IT?
So that's a really good. Oh, go ahead, Jered.
Sure, I can give my quick thoughts, and Erin, maybe you could jump in here too. But I would say it really depends on the entity itself. I'd say in a full, let's say a bigger public company that has an internal audit department already that's trained at looking at these types of SOC 1s and helping educate the relevant team members that actually interact with those systems, they might be the most appropriate people to actually do this review process to help, let's say we're talking about a record keeper specific SOC 1. That might be helpful controls for HR to understand. And if there is an internal audit team that is able to interpret the SOC 1 and even help structure to ensure that the HR controls are covering all of the CUECs, then perfect. Maybe that's the best person. Another common SOC 1 that we see are things like payroll SOC 1s. And again, maybe in that instance, if you have an internal audit, they can help address that. But again, maybe in a smaller company that you don't have an internal audit function, maybe the HR team should be reviewing the record keeper specific controls because that's more of a function of what they're doing versus payroll. It depends on the division responsibilities of HR and payroll at each company because sometimes those can be blended specifically for the 401k responsibilities. So it really does depend, but it's helpful. I think those are the three main players that I would generally see reviewing these in addition to maybe finance. But Erin, what do you see?
I agree 100%. The thing that I believe is important to note in this area is, to just make sure that, if say the finance or accounting department is, taking the reins on internal controls within the company, that, they're communicating with the HR department and the payroll department, like Jered said. I think sometimes during our audits, we, see maybe a little bit of a disconnect where, the finance or accounting team, is answering all the questions related to internal controls and, HR maybe just providing the documents. And I really think it's important to include HR's perspective, with in the area of internal controls surrounding the plan, and to make sure that they're aware of the importance of the controls and are able to speak on them as well.
Okay, I'm going to squeeze one question in here for you, Erin, and I think we have to go. How can you confirm if the signer is authorized on the certification? I know you and I have had discussions about this.
Yes, we have. There is no formal guidance out there regarding what you should do, but both management and the auditor has a responsibility to make sure that the certification is signed by an authorized signer. So my best advice there would be, as an auditor, I can't tell another auditor what they should be doing to verify, management's due process in this area. But, typically what we'll do is we'll make sure that management has, number one, performed the evaluation, and then number two, what was their process? Did they look at the title? Did they, Google the individual? Did they, do anything at all? And then from a perspective of management, basically your responsibility is to consider it and make sure that it was an authorized signer. So, was it a vice president of the institution? What was their title? Does it include any background? What are your thoughts on that, Katrina? I know that it can vary.
I agree. Yeah, most of the time we see vice presidents signing, and I think that's usually acceptable. Well, it's 10 o'clock, so I'm going to thank you both. As I predicted, there was tons of information in that presentation. Very well done. Thank you so much. Thank you to the audience, and I will turn it back over to Emily to close it down.
All right, thank you, Katrina. And thank you so much to Jered and Erin for a great presentation today. We certainly covered a lot of information. We did have some questions come in that we didn't have time to respond to, but we'll be doing our best to follow up with you after the webcast. And if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.